Next question. X and company is contemplating whether to replace an existing machinery or to spend money in overhauling it. X and company pays no taxes. The replacement machinery costs 95,000 rupees and requires maintenance of 12,500 rupees every year. At the end of 8 years, it would have a salvage value of rupees 25,000 and would be sold. The existing machinery requires increasing amount of the maintenance each year and its salvage value falls each year as follows. Maintenance expenses have been provided to us and its salvage value is given. The discounting rate opportunity cost of X company is 15%. You are required to state, highlight the portion. When should the firm replace the machinery? When should the firm replace machinery? That is a question. Present value of an annuity of rupee 1 per period for 8 years at an interest rate of 15% is given. Present value of rupee 1 to be received after 8 years at interest rate of 15% is given. I request all of you to go through the question please and then we'll discuss how to do answer. Dear students, over here the question is providing the information like this. Listen carefully. Let's say there is a new machinery, price of the machinery is given, maintenance cost is given, scrap value is given to us, and its useful life is given. It means that the entire information is given to us with respect to the new machinery. First of all, friends, we'll make the computation of equalized annual cash outflow for this new machinery. Why do we compute the same? I just explained that to you in 2 minutes of time. First of all, I want to calculate the equalized annual cash outflow for new machinery. Why? I just explained that to you. I request all of you to write an answer. Working note number 1. Calculation of present value cash outflow for new machinery. In the breakdown, year 1 to year 7 and 8th year, cash flows. Maintenance expenses given to us 12,500. At the end of the 8th year, scrap value is given 25,000. So there is a cash inflow of 12,500. Discounting factor is given to us 15%. Last year factor is 0.3269. 1 to 8 factor summation is given 4.4873. So I eliminate the last year factor and based on that I'll get the first 7 years factor. 4.1604. So 12,500 into 4.1604. It is 52,005. $12,500 into 0.3269. 4086.25. Minus 52,005. So the answer is 47,918.75. Okay. And then we understand that there is a purchase price of the machinery, that is an amount of rupees 95,000. So the present value cash outflow is 1,42,918.75. This is the way the present value cash outflow can be calculated. Okay. After we make this calculation, dear students, we'll compute working note number 2. Calculation of equalized annual cash outflow. It is present value cash outflow divided by PVIFA at the rate of 15% for 8 years. 1,42,918.75. Divided by 4.4873. 1,42,918.75 divided by 4.4873. That comes to 31,849.60. Now friends, the important point of the question that I want to discuss you is this. X&M company is contemplating whether to replace an existing machinery or spend money in overhauling it. That is a question. X&M company currently pays no taxes, so we did not bother to compute depreciation. Replacement cost is 95,000, maintenance is this much, and it will have 8 years useful life. Salvage value is given. The existing machinery requires increasing amount of the maintenance each year, and the salvage value falls each year as follows. It means that say if at all we use the existing machinery in the first year, then its maintenance cost will be 10,000 and scrap value that we can realize is 25,000 instead of 40,000 today. If at all we use it in the second year, instead of selling at the end of the first year, it will have the maintenance expenses of 20,000 rupees and its scrap value will further fall from 25,000 to 15,000. Maintenance cost of 25,000 rupees in the third year, then in that case, the salvage value will further decrease from 15,000 to 4,000. The question is providing over here that the discounting rate is 15% and we are required to take a decision. Now the important part of the question is, the question says that when should the company replace the machinery? This is important. Over here, X&M company is contemplating whether is actually a wrong word that they have used. This is the correct word. When to replace the machinery? Because either the company can replace the machinery today, that is in the year 0, or after 1 year, or after 2 years, or after 3 years. These are the 4 options that we have. For example, right now we are operating with semi-automatic machinery. Right now we are operating with semi-automatic machinery. We are considering that say instead of semi-automatic machinery, now say we will purchase automatic machinery. If at all we purchase the automatic machinery, then in that case, what is the useful life of the automatic machinery? What is the purchase price of automatic machinery? What is the expenses? What is the scrap value? Everything is given. Based on that, say we have computed that say annualized cost of using automatic machinery is approximately 31,850. So what we will do, dear students, we will calculate that what is the cost of using existing machinery in the first year. What is the cost of using existing machinery in the second year? What is the cost of using existing machinery in the third year? How to compute that? I am just explaining that to you in 2 minutes of time. Suppose the answer is, it is an amount of 27,000. Suppose the answer is 35,000. And suppose the answer is, let us say 45,000. I want you to write in the chat box what is the optimum point at which we should shift from semi-automatic to automatic. So friends, we understand that say using existing machinery in the first year has an expense which is 27,000 randomly that I have assumed. It is less than 31,849. So it is better that say in the first year we use existing machinery. In the second year, using the existing machinery becomes expensive. So we would advise the company that said do not use the existing machinery in the second year. Instead of that, you should replace existing machinery with new machinery at the end of the first year. What is the optimum time at which you should replace existing machinery with the new machinery? We understand that the optimum time is that you should replace existing machinery with the new machinery at the end of first year. That is what we understand. In friends, information of the question is such that the cost of using the existing machinery will keep on increasing. So if at all like we replace at the end of the first year, then in that case it is definitely better. Why? Because in the third year it is going to be more expensive than second year. Okay. So let us understand that say how to make the calculation of cost of using existing machinery from end of year 1 to end of year 3. Listen carefully. We will have working like this. I request all of you to write down answer along with me. In this question, we already have decided to purchase new machinery. Full stop. Now we have to find what is the best time to replace existing machinery with new machinery. Full stop. In above working, we found that what is cost of using new machinery in annualized term. Full stop. Using existing machinery will surely be more and more expensive with time passing by. Full stop. We have to find what is the cost of using existing machinery, comma, at the end of every year. Full stop. Heading right down. Cost of using existing machinery, comma, at the end of every year. First year end, second year end, third year end. Now friends, how to calculate the answer? That is very simple. We would be having one maintenance expense is 10,000. We would be having loss of the scrap value 15,000. And the third is interest income forgone on the salvage value. So it will be like this. Listen carefully. You will incur the maintenance cost of 10,000 rupees. Salvage value will decrease by 15,000 rupees. And 40,000 rupees, let's say, you could have received at the end of the first year, that could have been invested at 15%. And you could have received the interest income of 6,000. So 40,000 into 15%. 6,000 rupees of the interest income forgone plus 15,000, that is loss of the salvage value, plus 10,000, that comes to 31,000. That is the way cost of using existing machinery at the end of the first year can be found. Now, if at all we use the existing machinery in the second year, then there is maintenance cost of 20,000. Salvage value you can receive 15,000 instead of 25,000. Because we have to think that say we are using in the second year instead of selling at the end of the first year. So we understand that over here you receive 15 instead of 25. And this 25,000 could have been invested at the rate of 15%. So what will happen? This 25,000 into 15%. So that interest income forgone plus loss of 10,000 plus 20,000, that is 33,750. Third year, there is no need to calculate at the end of the third year, but still only for understanding I am doing it. 25,000 plus, instead of 15, you receive 4. And this 15,000 could have been invested at 15%. So 2250 plus 11,000 plus 25,000. So 38250. So this is what we understand is, so the cash outflow at the end of year 1 to year 3 end. This is the cost of using existing machinery. Now we can see that the cost increases in the second year. So we advise the company that you should sell the existing asset at the end of the first year. So read on with paragraph. The company is advised to replace existing machine with new at the end of year 1, full stop. Okay. Before I proceed further, just one small point. I want all of you to write in the chat box that this 31,849.6, this is the cash flow of year 0, or this is the cash flow for any other year. Please write answer in the chat box. So friends, this is the cash outflow, not of year 0. It is the cash outflow. We understand that, say, technically speaking, let us say that, say, in year 0 I purchase a machinery, then it is end of year 1 to end of year 8. Technical language it is called, it is in the equalized annual term. This is what we understand. The year in which you buy the machinery, for subsequent 8 years in annualized term, this is the cash outflow. This is also end of year 1 cash outflow, so it can be compared. This is end of year 2 cash outflow, so it can be compared. This is end of year 3 cash outflow, so it can be compared. What I want to tell you is that, so there is no need of the discounting, because both of them are in the comparable term. See, we have advised over here that, say, you should replace at the end of the first year. Why? That is, we can write further like this, because cost of using existing machinery in second year is more than equalized annual cash outflow of new machinery. So there is no need of discounting. So small summary of the entire answer, dear students. This is the question wherein we use the equalized annual concept for the decision making. This question is that, say, when to replace the existing machinery. As far as the new machinery is concerned, that for that, say, we have been provided with the information that what is the present value cash outflow, what is the equalized annual cash outflow, that is what we have done. Afterwards, what happens that, say, we have to compute that, say, what is the cost of using existing machinery on yearly basis. The year in which the cost of using existing machinery exceeds the equalized annual cash outflow of the new machinery, in its preceding year, we should replace it. This is the way we are required to write the answer.